Hello, this is Jordan, and this video is being recorded on the afternoon of Tuesday, October 11th, 2016. And in this video, I'm going to discuss where and why I see signs of inflation starting to creep into the markets. Now, in our last video, we talked about signs of inflation in the CPI. In this one, we're going to focus a little bit more on the markets. Starting off here, this is my master fundamental chart for gold. Remember, the fundamental driving force for gold and precious metals is declining real interest rates or negative real interest rates. And so you're basically talking about the difference between inflation and interest rates. And there's two things that can happen. I mean, there's two ways it can happen to be bullish for gold. You can have interest rates going down faster than inflation is going down. That's bullish. That's what you kind of get in a deflationary situation. But also, in an inflationary environment, when you do have interest rates and bond yields rising, if inflation is rising at a faster rate, that is bullish for gold because that means real interest rates are declining. And where we are right now, I mean, we've heard all this Fed jawboning. They really want to raise rates. It looks like they're probably going to raise rates. I mean, it was last I checked was nearly 70% priced in a December hike. In bond yields have been going higher, and so that in the short term is negative. But the Fed is starting to see inflation creep up. That's why they're raising rates. And ultimately, what as precious metals investors and bulls, what we need to see happen is we need to see signs of inflation. We need to see inflation rising faster than rates. And look, if the Fed only hikes by 25 points, or even if we're looking out 6 months and they do two hikes, inflation doesn't need to rise that much. I mean, we're only talking about 0.5% or 1%. So that I mean, in the big picture, one or two hikes is not very is significant. I mean, it's not a real negative fundamental development for precious metals. I mean, I've talked about this before many times, but the real key now, assuming the Fed is going to raise once, maybe twice, and assuming yields keep rising, and looking at the yields charts, the charts of the 2, 5, and 10-year yield, they look like they're going to continue to rise in the near term. And so, getting to my second chart, what we really need to see is signs of inflation in the markets telling us that inflation is going to pick up. And these are various indicators of inflation or inflation expectations. Uh, I've plotted the yield curve here, the difference between the 10-year bond and the 2-year bond, the difference between the rates. And so I have one where it's the 10 divided by the 2, one where it's the 10 minus the 2. So there's two variations. Then we also have TIP, which is the inflation protected bond divided by TLT. And obviously we have the CRB, oil, and then the silver gold ratio. And so looking at the yield curve, I mean, if you look at the 10 divided by the 2, it's bottoming, but it hasn't turned up yet. The 10 minus the 2, as you can see there, we do have a little technical breakout. It appears over the last couple months that that variation of the yield curve has bottomed, and in the months ahead, that could follow through and trend higher. Still has some ways to go before it gets to the 400-day moving average. If you look at TIP divided by TLT, we see the same thing where that has bottomed in the last couple months, and there's a little bit of a downtrend breakout there. That probably is going to go up and rise to the 400-day. Skipping down to oil, that's what makes me really encouraged. If you look at the price action of oil over the last several months, it's been fighting with the 400-day moving average, and recently it's pushed above it. I mean, I've seen a lot of people on Twitter talking about, oh, well, oil has diverged from the dollar, it'll go back down. A lot of people are saying that, but if you look at the price action of oil, it looks like it's bottomed. It's back above the 400-day, looks very bullish. And oil is obviously a big part of the CRB. I mean, I've talked about how those weightings are messed up, but the CRB, I mean, it's consolidated like oil over recent months, and it's mounting an attack on its 400-day moving average. And then if you go down to the silver gold ratio, it's been very weak the last couple months. But I mean, that has already been above the 400-day moving average, which is starting to slope upwards. So what we want to see from that ratio over the next 4 to 6 weeks or 2 months is just it bottoms, it holds the 400-day moving average, and then it starts to trend up. I mean, silver outperforming gold. That is a major sign of inflation. And silver has been outperforming gold. It's above the moving average, but we just need to see a retest of that support and then a reversal follow through the upside. That would be very bullish. So, and we already mentioned that oil is above its 400-day moving average. Natural gas is very strong. So, energy is a big driver of inflation. And we talked about in our last video how the sticky CPI and the core CPI, I mean, inflation is firm there. The problem is there just hasn't been much commodity inflation. So what's going to happen if oil, if this breakout here and this bullish price action is for real? I mean, we see the same thing in natural gas, but that tells us that the CPI could really be picking up quite a bit in the months and quarters to come. And another thing I didn't show here uh, is industrial metals. And industrial metals have been strong, and the Goldman Sachs Industrial Metal Index is above its 400-day moving average. So that's above it, and oil's above it, and I mean precious metals already went above that moving average months and months ago. So they just need to hold support and trend higher into next year. So, I mean, looking at all these things, we're already seeing signs that there's going to be a transition to inflation in the markets. And that is going to, I mean, that is what, if bond yields are going to move higher and the Fed's going to hike once or twice, that's what precious metals need to see. So there's good signs here and now, but we need these things to continue in the months ahead, the weeks and months ahead, I should say, and I think they will because we're seeing key technical changes here. And remember, commodities, I mean, they've been obliterated for the last 4 or 5 years, uh, and uh, I just think that these good signs that we're seeing here are going to continue, but it will take a little bit of time before the market kind of realizes this and realizes it's bullish for precious metals. And the reason it's bullish is because if it continues, then we're seeing a rise in the rate of inflation, which is going to rise much faster than the Fed's hikes for sure. Because I mean, we've talked about it many times. The Fed, they want to let inflation run. We need, the whole world needs inflation to pick up, and we need negative real interest rates for this global debt bubble to really be deflated and devalued in real terms. Because inflation is really the easiest answer. And if you don't get that, I mean, you're really in a lot of trouble, as we've seen. But anyway, I know that's a lot to chew on. But moving on, one more chart, which a lot of people watch because it deals with the bond market. And I mean, this is similar to the TIP to TLT ratio. But look at inflation break-evens, and we're looking at the difference here in the 10-year inflation protected security, the difference in that against the difference in the regular non-inflation protected security. So this is an indicator of inflation expectations, and when it's rising, inflation expectations are rising, et cetera, et cetera. Now, clearly this was trending down from 2013 to 2016, but it bottomed in February, made a pretty good move higher, made a higher low in the summer, and it's continuing to trend higher here, up above 1.6%. And um, I mean, eventually, if this gets above 1.7 to 1.8, I mean, it's going to start to look a lot more bullish. So it certainly looks like a bottom is in, and I think it's going to follow through and continue in the weeks and months ahead. So again, not to repeat myself too many times, but the main points here are that bond yields are moving higher. The Fed is probably going to hike once in December. Maybe they'll hike at some point next year. And so, what precious metals need is we need to see inflation rising faster than yields and the Fed funds rate. And the early indications that we're seeing in these charts are saying that yes, that will happen, but that doesn't mean it's going to happen here and now immediately in the next month. I mean, this looks like a 2017 story. To sum things up, well, I already summed things up actually. Just rewind 30 seconds if you want to hear that again. But anyway, that's all I have for you today. Hope you enjoyed it. Hope it was informative for you. You can follow all my work at thedailygold.com. You can opt in there for my free weekly newsletter, which comes out once a week. And again, thank you so much for listening and watching. And I hope to do another video update for you in the weeks to come. Thanks.